Hello everyone, welcome to my channel. Today I'm going to talk about how bookkeeping saves you money on taxes. When tax season arrives, many business owners focus on one question: how much do I owe? But there is another question that can make an even bigger difference. Did I track every expense and deduction I am entitled to claim? That's where good bookkeeping comes in. Bookkeeping isn't just about recording income and expenses or keeping your accountant happy. When it's done correctly throughout the year, bookkeeping can help you identify legitimate tax deductions, avoid costly mistakes, and make sure you are not paying more taxes than necessary. In this video, I will look at exactly how organized bookkeeping can save your business money at tax time. The first thing is you do not miss valuable deductions. One of the biggest ways bookkeeping can save you money is by helping you track business expenses. Businesses can generally deduct ordinary and necessary expenses related to operating the business, depending on the applicable tax rules. This might include things like advertising, software, office expenses, professional services, business insurance, supplies, and certain travel or vehicle expenses. The problem is that small expenses can be easy to forget. Maybe you paid for a software subscription 6 months ago. Maybe you purchased office supplies with business card. Maybe you paid for professional services and forget about the invoice. Without organized bookkeeping, those expenses can disappear into your bank statements. With consistent bookkeeping, they are categorized and recorded throughout the year, making it much easier to give your tax professional complete and accurate information. The second thing is accurate records help support your tax return. Claiming a deduction is one thing. Being able to support that deduction with proper records is another. Good bookkeeping creates a clear paper trail showing where your business money came from and where it went. Your books can help connect transactions to receipts, invoices, bank statements, credit card statements, and other documentation. That matters because good records can make it easier to substantiate legitimate business expenses if questions arise. In other words, bookkeeping isn't simply about finding deductions, it's also about documenting them properly. The third thing is it helps separate business and personal expenses. Mixing business and personal finances is a common problem for small business owners. When everything flows through the same bank account or credit card, it becomes much harder to determine which expenses are actually business related. That can lead to too expensive problem: claiming expenses that should not be claimed or failing to claim legitimate expenses because you are unaware whether they qualify. Maintaining separate business accounts and recording transactions properly makes the distinction much clearer. Your accountant then work from clearer information and make better decisions about what belongs on your tax return. The fourth thing is Bookkeeping can catch errors before tax season. Imagine waiting until April to discover that your books do not match your bank account. Now we are scrambling to find missing receipts, explain transactions, track down invoices, and figure out why the numbers do not add up. That takes time, and time costs money. Regular bookkeeping allows you to reconcile your accounts and identify errors throughout the year. Maybe a transaction was entered twice. Maybe a customer payment was recorded incorrectly. Maybe an expense was categorized in the wrong account. Finding those issues early is much easier than trying to reconstruct an entire year's financial activity at the last minute. The fifth thing is it helps your tax professional work more efficiently. Your accountant or tax preparer can only work with the information you provide. If your records are incomplete, they may need to spend additional time sorting through transactions, asking questions, and reconstructing financial information. Clean books makes their job easier. And when your records are organized, your tax professional can spend more time analyzing your situation and less time trying to figure out what happened in your bank account. That can potentially reduce professional fees while also improving the quality of your tax preparation. The sixth thing is you can make better tax decisions during the year. Perhaps the biggest advantage of bookkeeping is that you do not have to wait until tax season to discover what's happening financially. If your books are up to date regularly, you can see your income, expenses, and profitability throughout the year. That information can help you and your tax professional plan ahead. Instead of discovering your tax liability after the year is over, you can potentially make informed decisions before year end based on your actual financial numbers. The keyword here is planning. Tax savings should not be about hiding income or inventing expenses. It's about understanding your financial situation and taking advantage of legitimate tax rules that apply to your business. In conclusion, I believe good bookkeeping does not magically eliminate your tax bill, but it can help make sure you are paying the right amount of tax rather than accidentally paying more because expenses records were incomplete or financial information was inaccurate. Think of bookkeeping as more than a record keeping show. It's a financial tool that helps you track deductions, documents expenses, catch mistakes, for taxes. So if you own a business, do not wait until tax season to think about your books. Keep your records organized all year. Work with a qualified tax professional and make your bookkeeping work for you, not against you. And remember, tax rules vary depending on your business structure, location, and individual circumstances. So always consult a qualified tax professional before making tax decisions. Thanks for watching this video and do not forget to subscribe to my channel.